Okay, what we're going to cover here is how the direct and the indirect methods are prepared. We're not going to go through the calculations and do the math, just conceptually, visually, what it is that's being done under both the direct and the indirect method. Now, we need to start by saying you don't need to know how to prepare the operating activity section under the direct method. You only need to know how to do the math and how to make that preparation, all those calculations, under the indirect method. But I think it helps a lot if you understand how the direct and the indirect methods are so very similar to each other. There's a minor difference, but it's not a very big one when we get right down to it. Now, the issue that we have is under both methods, when we're calculating the operating activity section, what we're really essentially calculating is cash flows from operating activities. And what we're going to do, obviously that's the name of it, I guess, but what we're going to be doing under both methods is we're going to be starting with the income statement. And we're going to make adjustments to the income statement to eliminate the things in the income statement that are not cash and also not operating activities. And so we start with the income statement, we take out the things that aren't cash, we take out the things that aren't operating activities, and we may add in some transactions that are cash transactions but aren't in the income statement, and those need to be added in. So what I've done here, so you didn't have to watch me write it all, is we've essentially created a very basic income statement. We've got revenue minus cost of goods sold minus rent expense minus depreciation expense plus the gain on the sale of a fixed asset. All of that is equal to net income. Now, we could have put in 17 more expense lines. Okay, we could have put in salaries expense, marketing expense, whatever it is. But once it's an expense, it's all going to be treated fundamentally the same way under the statement of cash flows and the calculations that we're doing. Now, this is the income statement, and we can see that in this income statement there are things that are not cash. For example, depreciation expense. We don't pay somebody the depreciation expense. Okay, so that's a non-cash item. The gain on the sale of the fixed assets, well, that's not an operating activity. Fixed assets is an investing activity, and so that gain on the sale, the cash from that transaction, from that sale of the fixed assets, needs to be shown in the investing section. So what we're going to do, and we'll look at the direct method first, okay, what we're going to do is we're going to take each of these lines of the income statement and we're going to make adjustments to it. Now, these adjustments might be some additions, they might be some subtractions, but we're going to make adjustments to this revenue number, which is an accruals-based number, and we're essentially going to make all of the adjustments necessary to create a line that's not revenue, because revenue has a very specific meaning. But we're going to make the adjustments, so what that line becomes is cash received from our customers. Okay? That's going to be probably the first line, hopefully the first line under the direct method. We're not doing this on the exam, but in the direct method is going to be cash received from customers. We're then going to go through each of these individual lines and make adjustments to it so that it becomes a cash number. So cost of goods sold, we're going to make some adjustments. Okay, we're going to adjust for payables, we're going to adjust for inventory, and we're eventually going to come up with a line that's called cash paid to our suppliers. Okay, that cost of goods sold number becomes cash paid to our suppliers. We're going to make adjustments to rent expense, and that's going to become cash paid for rent. Okay? Cash paid for rent. We're going to take depreciation expense. Now, depreciation expense is kind of a unique adjustment because the adjustment is actually an elimination. But we'll put in here, we'll do our adjustment, and it becomes nothing because there is no cash paid for depreciation expense. And so I guess what we need to say here is this isn't an adjustment, this is an elimination. Okay, we're going to go ahead and eliminate that line because on the statement of cash flows there is no line cash paid for depreciation. Now, this gain on the sale of the fixed asset, there is a cash transaction there. We did receive some cash, but that cash received needs to be on the investing section. And so this is also going to be eliminated, not completely from the statement of cash flows, but it's eliminated out of the income statement to calculate cash received from the sale of fixed assets, because that goes not in operating activities, that goes a little bit lower in investing activities. So we're going to go through every line in the income statement and come up with a corresponding cash number. And what happens is all of that is going to lead us to cash, we'll be optimists and say it's a positive, cash received from operating activities. Okay? Cash received from operating activities. And that is the direct method. Okay, let's put that up here. This is the direct method. Okay? Now, we've got the direct method cash flows from operating activities, and we know that this number, cash received from operating activities, under the direct method, is equal to, exactly equal to, the cash received from operating activities under the indirect method. Okay, so that is going to be exactly the same. Now, what I'm going to do here is, under the indirect method, we don't make adjustments to individual lines, but we make adjustments to net income. But ultimately, what's going to happen down here is we're going to have cash received from operating activities, and this is the indirect method. Okay, so put down here, this is the indirect method. Now, we have adjustments that we have to make, but I want to point something out here. Remember, these two numbers are equal to each other. Right? The direct and indirect method have exactly the same cash from operating activities. Under the direct method, what we do is we start with each individual line of the income statement and make adjustments to it. Under the indirect method, we're going to make adjustments to net income. Okay? We make adjustments, all the adjustments come out of net income. So these adjustments that we have to make, okay, there's going to be a bunch of them, but let's do some math here. If the starting point of the direct method is the individual lines of the income statement, and the starting point of the indirect method is net income, these two numbers are equal to each other. Okay, we have the same starting points, just presented a little bit differently. The income statement has each individual line, and net income is all of those lines added together. But if the indirect and direct methods start with the same point, start with the same amount, and end with the same amount, what that tells us is that these adjustments that we make under the indirect method have to be exactly the same as the adjustments that are made under the direct method. They're exactly the same adjustments. Every adjustment that we have to make to revenue, we have to make to net income. Every adjustment we make to cost of goods sold, we have to make that adjustment to net income. The adjustment to every expense has to be made to net income. The fact that we eliminated depreciation expense, well, we need to eliminate that from net income too. The amount of the gain that was eliminated under the direct method, we have to eliminate that from net income. Okay. Now, all of this discussion here comes down to just demonstrate that the adjustments are the same under both methods. What's different is how they are presented. So under the direct method, what the statement of cash flows looks like under the operating section is cash received from customers minus cash paid to suppliers minus cash paid for rent minus cash paid for salaries minus cash paid for marketing equals cash flows from operating activities. Under the indirect method, what it looks like is net income plus or minus an adjustment for a change in receivables, plus or minus an adjustment for the change in inventory, plus or minus a change for the adjustment in payables, plus or minus a bunch of adjustments simply to net income. Now, personally, I think the direct method is a lot more useful. Hey, cash received from customers, that number means something. When you start with net income and you just make adjustments for changes in receivables, you make adjustments for changes in inventory, changes in payables, that number by itself doesn't mean as much. Okay, so your receivables went up during the period. Okay, good, I guess. Maybe you sold more. Let's hope it's that instead of nobody paid you during the year and you just have all of these uncollectible receivables. But the direct method presentation looks like an income statement. The indirect method looks like a bunch of adjustments to net income. But the adjustments under both methods, whether the adjustments are individual lines under direct method or all those adjustments to net income under the indirect method, those adjustments are the same. Now, as I said, for the CMA exam, you don't need to know how to do all of these adjustments for the direct method. You need to be able to prepare it under the indirect method. Okay, so we're not going to go into all of the details about these adjustments to get revenue to cash collected from customers. We're going to talk only about the adjustments that are necessary. I mean, it's this adjustment, but we're talking about how it's going to be presented as an adjustment to net income instead of as an adjustment to the individual line. So the two methods, exactly the same end result. They have exactly the same beginnings, just formatted a little bit differently, either the individual lines of the income statement or net income. And so the adjustments under both methods are going to be the same. The difference between the direct and the indirect method, I've said it a number of times already, the difference between the direct and the indirect method is simply the presentation. Simply the presentation of the operating activity section of the statement of cash flow. Don't let it become more than that. Don't let it become more difficult than it already is. It's not that difficult, but we don't need to make it any more difficult than it needs to be. So the difference between the direct and the indirect method is simply in the presentation of the operating activity section of the statement of cash flows.